This is the study session on financial reporting and analysis in the reading on long-lived assets, two types of long-lived assets, and so I want you to make sure you distinguish between the two. There are tangible and intangible long-term assets, so I want you to think of the tangible assets as the buildings and the pieces of equipment and machinery that companies use to manufacture or to produce or to assemble their finished product lines. Think of the giant opens. In a bakery, think of the various types of solid enough furniture manufacturing factory, but then for intangible assets, think about assets that really don't have a physical presence, but clearly they're an asset and clearly they pay off over the long term. When I think of intangible assets, I always think of the National Football League. Guys have been watching my videos know I like to get sports analogies. The NFL's trademark, those three letters NFL, and if it shows up on everything. It shows up on the cities and the teams and their equipment, and they're the stuff that they sell to the public. And what that does is identifies it. Of course I'm gonna fight it as an NFL asset, and then it prevents other people from using it. Like for example, if I'm a large company that makes soup and I want to try to get some new recipes for soups that I can make, and I invite a bunch of cooks, and I say, hey, bring your soup or your Super Bowl. Well, I can't use that because the NFL has trademarked the term Super Bowl. That's a silly example, but maybe it's the one that helps you memorize some of the stuff. Alright, let's get into the loss. Distinguish between costs that are capitalizing, costs that are expense high. This is a big deal. If we're going to expense one of these costs, and remember his machinery and equipment that costs sometimes tens of millions of dollars, hundreds of millions of dollars, even billions of dollars. If we're going to expense those, think about what that giant balloon expense looks like on the income statement. Is going to wipe out all the other revenues that we're generating, and so we capitalize these, call us over the fixed life of the asset, so that they are smoothing the income or the earnings of the business over some time. Alright, so some costs are capitalized, while others are expensed. They're capitalized. You ready for this? Capitalized if they're gonna provide economic benefits for more than a year. And so think about the NFL trademark. Of course the NFL, they've been around since the 1950s, let's say, and even though attendance is a little bit down to lots and lots of people still watch professional football, so they're probably going to be around for quite some time. On the other hand, if the costs are going to cost should be expensive, the economic benefits will probably accrue in a year's time or less. And so there are some good examples under the blue balloons, their acquisitions and upgrades. Think of those things are under the left-hand balloon, as increases in the positive net present value of those long-term assets, and then over there on the right-hand side, just think of those expenses as minor. Can I say minor? Really, or smaller, relatively smaller expenses. It can be used for repair. Once again, that final bullet point is important to recognize that what the capitalization process does is it spreads those huge costs over the life of the asset so that there's not a giant hit to operating income and net income and any other kind of income that we've measured in this discussion on financial statements and financial ratios. High constructed assets, these are buildings, machinery and equipment. The international standards suggests that the initial construction cost and interest expenses on the borrowing should be capitalized. The US GAAP agrees with all that. And in addition the US GAAP recognizes that interest earned should be included in that capitalization. Now how does the difference between capitalizing and expensing affect all of the readings that we've been looking up to in the financial statement readings up to this point? So whatever the kind of things that we've been talking about, we've talked about of course balance sheet and income statement and the cash flow statement, and then we did a whole series on things like financial ratios and profitability. And so here's a good slide to know. Capitalizing enhances current profits because it spreads those expenses out over time. And of course when we compute operating cash flow for things like calculating net present value, we're gonna add back those non-cash expenses like depreciation and amortization, so it will increase cash flow. An expenditure that is capitalized, think about this, we're gonna capitalize a long-term assets of the long-term asset, of course that's going to show up on the bottom left-hand side of the balance sheet, so it's going to increase the amount of assets reported, and then it will appear as an investing cash outflow. That big amount is going to show as a one-time cash outflow. Investing cash flow on the statement of cash flows, but then in subsequent periods what's going to happen is there's going to be a depreciation expense or an amortization expense over on the income statement. Remember, those are non-cash expenses that are used for a variety of reasons, for a variety of accounting theory reasons, but primarily what they do is they reduce the tax liability. What expensing does, of course, is it reduces the current period profits, but then since it's expense today and not expense in the next time, it will increase future profitability. And so it will reduce net income by the after-tax amount of the expenditure. And then once this expense occurs on the income statement, there's no hope corresponding addition to assets over on the balance sheet. And then of course, if there's no addition to assets on the balance sheet, and then there can be a depreciation and amortization expense over on the income statement. Hi, to help out different depreciation methods, and let's go ahead and calculate depreciation expense. I have a couple of slides. We will do some math. There's the calculate. You guys know that I love those calculate loss. We will start with the easiest of the depreciation methods, and we'll call this straight line depreciation. So here's the simple math. If we spend $100 on a long-term asset and we're depreciating in over 10 years, then that $10 of depreciation expense over that 10-year. But of course what complicates the straight line method of depreciation calculation is an estimate of residual value. And so to get that annual depreciation expense, we take the cost of the asset, the initial investment, the historical cost, subtract out that residual value. In note, it's an estimate, has to be an estimate, right? And we divide by the useful life for the estimate of the useful life. I remember when I was an undergraduate student as an accounting major, being 20 years old, thinking when it must be really difficult to buy a machine today, this kind of big crackers or cakes or something, and you expect to use it for 5 or 7 years, and then what do you think you're going to sell it for after 5 or 7 years? And then I used to think, what if you're maintaining the asset and its useful life is over in 5 years, then why would you want to? Why would you want to keep using it? But then I studied more accounting, and I realized that these are really important accounting theory questions, and the accountants have really good answers for these things anyway. 11 Final comment here, a lot of companies just assume their estimated residual value is just zero. Hi, how about if we take a look at an example? We've got $5,000 worth of coffee processing equipment. That makes no sense to me. I've had less than 5 cups of coffee in my life, so how to really know anything about coffee processing equipment? So $5,000, there's residual value $500, useful life of 4 years, so really we're not going to depreciate the full 5,000, we're only going to depreciate 5,000 minus 500, which is $4,500. And so what we're gonna do is take the $4,500 and divide it by 4. And that gives us $1,125 worth of annual depreciation expense. So look in the third column there, first column says years 1 through 4 depreciation expenses $1,125. So straight line depreciation, that's a fixed depreciation of constant depreciation expense every year. So we start with the beginning net book value of the initial cost, and then we work our way all the way down to the bottom right of that ending net book value of $500, which represents the residual value. I guess the accounts think that if we actually sell this for $500 in 4 years, no chance of that happening right in the realistic form of life, but then we would no tax liability, there would be no recapture, there would be nothing interesting that would happen at the end of 4 years, but of course nobody ever sells their asset for exactly their estimated residual value. And then accumulated depreciation there in the fourth column, of course that sounds to the $4,500. Which should make perfect sense. How about the accelerated method? So going back here just really quickly, straight line, what is that too? That's fixed depreciation expense every year, and so what the company get is they get a fixed subsidy in the form of a lower tax liability every year. But what happens if the farm wants to accelerate the depreciation and get more of a tax benefit early years and less of a tax benefit and later years? And so when you compute the present value of those things, there's more value to the farm for using these accelerated methods, so allocation cost is greater in the earlier years of course, and last in the later years. And the amount of depreciation expense is calculated as a percentage. I could come up with Jim's depreciation method, and for a 3-year asset I could say, alright, we're gonna depreciate 95% in year 13% a year to 2% in year 3. So that's an accelerated method, but as you guys probably can guess my message, Jim's depreciation method with 95% in year 1, that's kind of almost like expensing it, right? So the accelerated method kind of breaks out those depreciation expenses and they tend to decline by some relatively uniform and now over time. So examples include double declining balance and sum of the year's digits. Let's take a look at an example of using the double declining method. Let's suppose that we purchase a machine for $1 million we expected to last for 5 years. Residual or salvage value is $100,000. Now if we were using straight line depreciation, we would take the zero thought, the 1 million minus the zero, and then divide by 5, but we're gonna use the double declining method here, so what we're gonna do is we're gonna double declined, we're going to double the straight line depreciation amounts. Now when we compute the double declining Depreciation expense every year we ignore the salvage value alright, so look at this we have $1 million divided by the 5 years that gets us 200,000 right, so let's double declined it, let's double that amount, so look in the third column there next to in the row 2018, there's $400,000 worth of depreciation expense. Which means if you switch over to the prior column that the book value of the asset after that first year's depreciation is now 600,000, so what we do is we kind of pretend that we're depreciating this again over 5 years, so 600,000 divided by 5 years, was that get you 120,000 right, and then double that, so that gets you the depreciation expense of 240,000. And you just continue to do that down all the way to the bottom until you get to that $100,000 worth of residual value. See how cool that is? And so think about this really is an accelerated depreciation method. I mean look, you start with 400 in year 2018 and 4 years later in the year 2022 you're only depreciate and you know about 30,000 of the assets, so clearly this is an accelerated depreciation bath. So the firm is gonna get lots and lots of a lower tax liability early on and less of a lower tax liability later on. Units of production. This is particularly relevant for companies that want to match their depreciation expense with an actual production of some kind of a finished good or service. I mean it makes perfect sense to use like a straight line depreciation method for a building or a piece of equipment that can be used for lots and lots of different purposes. Like in my you guys know I used to work in the donut factory. You know they had a forklift, who knows how much that forklift cost, maybe it cost $5,000, but that forklift was used for lots and lots of stuff, so that makes sense. But if you can link the production process with that depreciation expense, then the units of production method might make some sense. And so all we're really doing here is taking a ratio of the amount of production that occurred during the course of the time period, like 1 year versus the total productivity over the life of the asset. You know, if we have a machine that's gonna make 1 million donuts over 5 years, and we think that we're gonna make say 300,000 of those donuts in the first year and then 250,000 in the second year, and so on, well then the depreciation expense makes sense, then should reflect that declining productivity, and that's all units of production method are. Here's an example units of production method. Here's the coffee processing equipment for $5,000. Residual or salvage value $500, useful life for years. Now remember that if we use the straight line depreciation method or the double declining balance method, we really don't care about that next bullet point, the productive capacity of 1,000 kilograms of coffee, but now what we want to do is we want to attach that productivity to the depreciation expense. So notice that we've got 1,000 kilograms over the life, but each year it's going to be 1,000, so they sum to 1,000, so what we're gonna do is take a fraction for each year's productivity and the multiply by the depreciable about. So if we take the 400 in year 1 divided by the total of 1,000, that gets us 40% right. Take 40% of the difference between the initial cost of 5,000 and then the residual value of 500, so that's 4,500 times 40%. And that gives us $1,800 worth of depreciation expense, and then we just do the same thing as we move down for years 2 and 3 and 4, we're going to multiply the book value by the 30% and then the 20%. And so note that in this case since our productivity declines, which makes some sense that the machine when we first start making this, I'm processing this coffee, the machine is brand new, perfect, is not making any mistakes, and so it's at its capacity right for that first year. But then over time it kind of wears out a little bit, and maybe there's some spoilage, we have to throw a couple things away, maybe we have to shut the machine down to repair, and so that accelerates over time, and so once again this units of production method results in a accelerated depreciation, accelerated, but not in the sense of the accounting acceleration that we did before, but in a sense of the acceleration because the productivity to clients. Alright, how about this? Lost the choice of depreciation methods and assumptions concerning useful life and residual value. So, how does that choice of any of those methods affect things like depreciation expense and financial statements and in ratios? Well, the accelerated methods are going to result in, of course, higher depreciation expenses, and it really appears we set that. What that means then? That there will be lower operating profit margin and operating return on assets in the earlier years, but that will then be reversed in the later years. What this also results in is lower average total assets in the earlier periods and then a higher asset turnover ratio, so this is important as a financial analyst to know what kind of depreciation methods, what kind of useful life estimates, what kind of residual or salvage value estimates that the business is making so that we can make a comparison of different companies who do things differently. Remember, the accounting bodies allow a wide range of choices, and so it's not fair to compare firm that's reporting straight line depreciation with the firm that reporting double declining balance depreciation, unless we know the differences, and then we can make adjustments. Right, how about intangible assets? So how do we define those intangible assets? They really don't have a physical presence or a physical substance. You can't really look over there and see a machine. For using my example, when you watch the National Football League and you see these talented athletes throwing passes and leaping over defenders and catching a touchdown passes in the air, you look and you think, hey, that's the whole. And so how do you deal with amortization? So amortization is the intangible asset sidekick to depreciation expense. So what we're doing, amortization is the process of allocating the cost over the useful life, just like depreciation. Now remember, that's an intangible asset with an indefinite useful life cannot be amortized. Wonder what the NFL is doing with their trademark is that an indefinite useful life for that they pick a date where they're going to stop operating. So there's a good bullet point: useful life. Is ever tried using the same methods as depreciation? But with an intangible asset is more difficult, maybe sometimes even really difficult to estimate that initial cost, So we need an original, now we need an estimate of its useful life, and then a residual value, and so these are much more difficult and complex. Here to an oven or a big soul for the furniture companies. Now how does the choice of amortization method in this is similar to what that earlier loss told us. Of course they're going to affect the financial statements, and so shorter useful life means higher amortization expenses each year over a shorter period, but the total accumulated amortization expense over the life is probably going to be affected. Its straight line method is used, then it's fixed just like it was with depreciation. If its accelerated method is used, then it'll be higher in earlier years. How about re-evaluation models? This is allowed only under the international standard. So these long-term assets, you start with the initial cost, that initial book values, right, full cost of the asset. You might consider some residual value, but then that book value is lowered by the amount of depreciation expense and of course the accumulated depreciation over time. But what happens when it happens if the value of the asset changes over time? Can you revalue that asset? Sometimes the asset increases in value and sometimes it decreases in value. It's also permitted for intangible assets, but only ones that have been active market, and the standard example there is for at least here in the United States, we have taxicabs in big cities, and they're given a license, and that license is set to expire after 3 years or 5 years depending on the city. And so those things are treated, because some people, they like to drive a taxi and they have a license and then they don't want to drive a taxi anymore, so they can sell it, so there has to be an active market. But supporters remember that this revaluation, it can result in an increase in value or a decrease in value, and it's probably, if you think about all the stuff that we talked about back in our economics readings, it's probably a reflection of the demand for horror. This particular product line, maybe the firm is selling way more than they thought they would, or maybe there's competition and they're selling way less than, so under the international standards, there's an opportunity to revalue. And so I think this slide covers the loss that asks you to describe the revaluation model, but let's go ahead and look at a quick example here. Let's suppose we have a machine cost $50,000, but at the end of the first period it's worth more than that, let's say $52,000, $52,100. And so under the international standards, what can the company do? The company can increase the asset value to $52,100, and so that increase in $2,100 is gonna show up as an increase in the value of the long-term asset, and then the corresponding credit over on the right-hand side of the balance sheet is a surplus under equity. But it doesn't show up on the income statement all. Then part B, suppose the fair value of the item after the second year is down to $4,800, and so then what we need to do is kind of reverse the reevaluation. And so instead of showing the asset has what was that $52,100, we now show it as $4,800, and then that loss, that reversal, is going to show up on the income statement. So that's probably a big difference to remember here. Supplies, come back to this slide. This is only under the international standards gap, requires you just use the cost model, and so remember that if you get that on the exam. What about impairment? is exactly what the name suggests, that you have some property or some plants or equipments or intangible assets and which the carrying amount, the amount shown on the balance sheet, is greater than its fair value or it's recoverable now. And so we have to have a write down, and so when the assets carrying about is not recoverable, we'll go ahead and write it down and impairment loss is recognized. And so of course this is not the answer you want at the international standard in the US standards. Consider these differently. And then you can reverse the impairment under the international standards, but not under GAT. So let's go ahead and take a look at some of these examples. So impairment, there has to be evidence. So what does that evidence mean? What I say earlier, decline in demand or obsolescence. Think about the machine. I wonder if any of you guys who are parents who have children who are, I don't know, in their mid-teens now, like I do about 45 years ago, they started wearing these rubber bands on their hand, on their wrists that were in the shape of dinosaurs or penguins or footballs. When they were not on your wrist, you can put them out on the floor, look at them all, and then you put on your wrist. Kids would wear tons of these things, and so what happens, that was a fad. It lasted for 2 years or so, and now we have 1 billion of those in our basement. But what about the machine that made those? Clearly those are obsolescent now, that product line. And so what does the firm do? I guess it has an impairment. Now let's do of course, the companies that make these things, they can easily retool their machine so they can manufacture the next fad. So there's probably not gonna be impairment for those kinds of the property, plant and equipment. But clearly there are instances where the long-term asset is impaired. All right, so what happens here is that we have to worry about a couple of new terms. We have to worry about a recoverable amount and the value in use. Now that value in use is going to be exactly the same thing that we talked about back in the corporate finance reading when we computed net present value. Remember, we had to estimate future cash flows, and so that value in use is going to be the discounted expected future cash flows. And that recoverable amount is going to be the higher of the two, the value and use which I just described, or the fair value less the costs to sell. Now under US GAAP, if it's not recoverable, then the measure of the impairment loss is gonna be the excessive via carrying about over the assets of the asset over its fair value. Here's an example. Let's suppose we have a special highest piece of machinery that makes those silly wristbands out of dinosaurs. Demand for the product has plummeted following the entry of a new improved product on the market. Alright, so there's the carrying them out of the asset, 21,000, the discounted cash flows 22,000, present value is 19,000, and there's the fair value of sold, and then the costs to sell. Alright, so what do we get? A report under the international standard and the US standard. So we have 5 numbers there, and we need to clearly identify which of those are important. So let me go back to that earlier slide. What are we looking for? The higher of its fair value, less costs to sell, and its value in use. So what we have here, fair value less the cost of sell, so that's 20,000 minus the 2,000, which is 18,000. And then how do we define that value and use the discounted expected future cash flows? So there we go, 19,000. So which one is the higher? And that's the 19,000. So that is all that stuff under the international standards. So let's go ahead and do the answer here. And so I have that there. So they were carrying him out as the 21,000, right? And then the recoverable amount is the higher of either at the 19,000, which was the present value there, and the top matrix, or the 18,000 in the bottom. And so the higher of those two is 19,000, so the impairment loss is 2,000. And so consider that against the US GAAP rules, carrying about 21,000, the undiscounted present value of the cash flows is 22,000, so there's no loss there under US GAAP. How about the recognition of property, plant and equipment and intangible assets? The recognition, that's one of those words that sounds like it's made up, but I think I probably use that word a lot. And when I teach my students, just because it's kind of the opposite of recognize, it's what you do after you recognize. So remember, what we've done is we've invested huge amounts of capital in our tangible assets and possibly huge amounts of capital in our intangible assets. Well, what if we get rid of them? And so derecognition means that we remove the asset from the financial statements. And so this occurs when the asset is disposed of or expected to provide no benefits. And so how do we do this? We can sell it, right? And we'll probably have some kind of tax consequences, unless for some strange reason the selling price exactly matches the book value of the asset. We can exchange, and this happens all the time. Businesses have an asset that they don't really want to use anymore, but they see another business that has an asset that business doesn't want to use anymore, so they agree to an exchange similar to a barter bargain. And so what each business is going to do is benefit because they have maybe different kinds of technology, or they can retool those machines so that they can fit their needs in the future, and then they can just abandon and abused several James Bond and Seinfeld examples. Remembrance Seinfeld car was smelling, and so he just took it to help has been abandoned. It's so abandonment is a third way to get rid of an asset. I don't know what Seinfeld has to do with the accounting rules, probably nothing. Or here's a great question: what about impairment and revaluation and the recognition? What is that? What is that? How does that impact financial statement and ratios? All right, so impairment, of course, reduction in the came out and assets on the balance sheet, as well as net income. However, impairment does not impact cash from operations, so that's an important point. Revaluations, remember, can either increase or decrease the carrying amount of the asset, so remember those implications for all the financial ratios of long-term assets go up or they go down, but then there's going to be some associated change in equity. If there's a surplus, and then there's going to be associated loss on the income statement if there is a decline in the carrying amount. Now, how do we present all of these things in our financial statements? Of course, on the balance sheet, that's where we put the long-term assets with whether it's tangible or intangible. On the income statement, that's where we show the depreciation expense and the amortization expense, and then in the statement of cash flows in the investment section, that's where investing cash flows are going to be acquisitions and disposals, and then of course depreciation and amortization is in the operating section. And then the notes are really important because remember, FITE has good financial analyst. We're gonna read the notes so that we can understand and we can decide about the decisions that the business owners have the business owners for the executives have made in terms of their choice of reshapation and amortization method. It's their choice of the expected useful life and historical cost by different kinds of categories, and then we'll be able to see accumulated depreciation. Of course, we couldn't get through a reading without asking the question, what does all this have to do with financial ratios? You know, it's good financial analyst and always swings back to evaluating the data on the financial statements, right? That's what we've been doing for all these readings, but then what we need to do as good financial analyst is we need to compute some ratios and do a trend analysis compared against the competition and industry after averages, and then make a judgment about which firms are undervalued and which firms are overvalued. And so one good ratio to remember here is this fixed asset turnover ratio. In fact, my undergraduate classes I ask about fixed asset turnover ratio on every exam, and which we talk about ratios, and so notice what's happening here: total revenues over net fixed assets, and of course that's an average from last year to this year, and what we want to do, we want to spend $1 on assets and then have hundreds of dollars in total revenues, but we've got to be careful because that denominator will shrink faster if we use accelerated depreciation and amortization rules. That makes sense then. So when a firm has a higher fixed asset turnover ratio, we need to ask the question, is it going to be higher because the revenues are higher, which is what we want, or is it going to be higher because the denominator has lower? So make sure that whatever you do ratio analysis, and I've said this before, make sure you ask yourself what's happening in the numerator, what's happening in the. Now there are some age ratios that are going to tell us about maybe how old the asset is, and then give us an indication of how much maintenance is required, and then maybe when it's going to have to be replaced, and then what depreciation expense is going to be. How about investment property? And so this is property that's purchased for the purpose of generating rental income or capital appreciation, or probably both. Under the international standard, you can use either the cost model or the fair value model. Under GAAP, there's really no specific definition of investment property, and so most operating companies and real estate companies that hold this kind of a property use the cost model. Now leases is a really fascinating thing because remember what we're talking about here in this big picture of these long-term assets. You know, these cost tens, hundreds of millions of dollars, and so the question then becomes, boy, how can a business all the benefits of owning the asset without actually having to take all the risks of owning the asset? And that's where this concept of leasing. So the owner of a long-term asset might say to another business, hey, you can have this asset for 5 years or 10 years, just paying me a certain amount every year. And so sometimes lease expense sounds an awful lot like rent expense, and sometimes it doesn't say anything like right. So let's go ahead and identify the differences there. A lease is a contract between the lessor or the owner of an asset, and let's see who is seeking the use of an asset. So in exchange for the rights to use the asset, the lessee makes periodic payments. I will be one of the advantage of leasing an asset over purchasing it outright. Well, I mean, you can save a lot of money. This is what I suggested earlier. Also provides less costly financing. There is less restrictive present provisions in terms of borrowing, because when you use our long-term massive from somebody else, somebody else owns it, you're essentially kind of borrowing it for a while. And then you really don't have to worry about obsolescence or residual value or abandoning it in a parking lot. Hi, so let's go ahead and identify the two kinds of leases, and then this will illustrate what I was saying just a few minutes ago. An operating lease, this is kind of like just a rental agreement. There is no transfer, and so the risks and the rewards remain with the owner of the asset. And so with this operating lease, really the only thing that happens is that on the income statement, the lessee will just show a lease expense, kind of like a rent expense, think of it that way. But if this is a finance lease up, which changes have dramatically, then stuff starts to happen as if we owned the asset, and so it substantially transfers the risks and rewards of ownership to the lessee. So you're reported on that balance sheet as an asset. You're reported on the balance sheet on the right-hand side has an obligation to you get the accumulated depreciation, and then you reduce the lease obligation. There is a depreciation expense, of course, and then there's an interest expense or finance charge. And so remember, the operating lease is very simple, the finance lease is very complex, but the finance lease kind of sound like all the stuff that we've talked about during this entire slide deck. But still, lease, it's not ownership. And that takes us through the long-lived assets. Next up are income taxes.